Live from New York at the opening bell, this is Business Today, where Wall Street shares are seeing a muted opening as investors mull over the US president's latest comments. Donald Trump says he'll demand an immediate drop in interest rates and softens his stance on tariffs on China. Also on the program, Japan raises its main interest rate as the world's #4 economy puts stagflation in the rearview mirror. And we'll be live in Davos with the managing director of the World Economic Forum, looking back on a big week for global leaders. Welcome to Business Today, live from New York. I'm Ritika Gupta, where Wall Street has opened slightly lower following President Donald Trump's latest comments on tariffs, which were seen as taking a softer stance on levies against China and raised the prospect of lower U.S. interest rates. The dollar fell to a one-month low against a basket of currencies. This follows record high closes in Europe and the U.S.'s S&P 500 on Thursday. So for more on all of this, I'm now joined by Dan Ahrens, the Managing Director and Portfolio Manager at Advisor Shares. So Donald Trump's comments, they seem to have caused quite a stir for the market, the latest being a softening stance on tariffs on China, saying that he'd rather not use them. So is this Trump, the negotiator, coming out? Do you think the markets were perhaps over-concerned about the prospect of tariffs?
Certainly. I think he is negotiating. The tariffs are a negotiating tool. I think some tariffs will be implemented, but for the most part, it's saber rattling. It's saber rattling to try to get what the Trump administration wants, which is a certain level of manufacturing coming back onshore in the United States, as compared to a great deal of offshoring that a lot have done in recent years.
And Dan, the other comment that Donald Trump made was, of course, about wanting to cut interest rates. This is something that the president does not have control over, but we do have the Fed meeting coming up next week. So interested to get your thoughts on the path of future interest rates.
Well, Donald Trump is a straight talker in many ways of what he wants. But yes, everybody knows that the presidential office can't directly affect interest rates, but he is expressing his wishes. Doesn't really have power over the Fed, but at least the Fed knows what direction he is looking. And back to these tariffs, actual tariffs, in a bubble, isolated, cause inflation. So there could be some short-term inflation depending on tariffs. But once again, as I said, the tariffs are mostly negotiation tools, saber rattling, if you will. And I think it's a very good focus on the long term as compared to very short term looking at inflation.
All right, we'll have to leave it there. Thank you so much to Dan Ahrens, and a special appearance from your cat as well. Thank you so much for joining us.
Thank you.
And let's get more now from the World Economic Forum in Switzerland. The sessions closed earlier after a consequential week dominated by an absent figure, the new US President Donald Trump, who delivered a remote address to the gathering yesterday. I'm joined now from Davos by Jeremy Jurgens, the Managing Director at the World Economic Forum. So first of all, what is the mood like in Davos amongst those business leaders after Donald Trump's comments on trade and economic policy? How are the world's business community digesting this? Again, is this Trump, the negotiator, coming out, or are they concerned for some sort of tit for tat and a global trade war?
Yeah, so we're wrapping up here with the mood of constructive optimism. I think people were quite keen to hear the wide variety and number of announcements he made on trade, on tariffs, on plans on energy, some things that he's rolling back, other pieces that he's introducing. There's also a bit of a wait and see mode. Which of these are, initially signals, and, how immediately will they come in and take place? So I think overall people are, cautiously or constructively optimistic, and then looking forward to see what comes next.
And Jeremy, AI was another big theme at Davos. Do you get the sense of sort of global cooperation from the business community? Or is it that this race is continuing to heat up? I mean, particularly we've seen between the US and China and Trump announcing that big AI investment, Stargate.
Yeah, we see both here. We have the $500 billion investment announcement that was made. I think this is just going on top of a number of other investment announcements that we've been seeing, from the hyperscalers coming across, both in the US, but as well as in other countries. I think one of the areas that people are quite interested to see is what will happen on chips and what are the regulations there. There's very strong demand for semiconductors to be used in these new AI data centers. And a lot of different regions would like to be able to build them and put them in place. We see a number of different industries actually starting to use AI. A year ago, people were saying, okay, 2 to 3 years ago. But what we heard this week is that a number of companies already have AI in practice, in production, in their organizations, especially everything around agentic AI, where they start using agents as actors inside their organizations to pick up tasks and roles.
And Jeremy, I want to dig into some of those geopolitical tensions at Davos. I mean, aside from China, Trump made comments on wanting the oil price to be lower, going as far as to say this could end the war in Ukraine. Has geopolitical risks overshadowed some of the perhaps economic optimism at Davos?
We launched our global risks report just coming into the meeting. So I think people had a good grounding of the range of risks that are out there. Geopolitical risks, economic risks are near the top of that setup. And what we saw here is it's important to look at various regions, right? We saw the ongoing war in Ukraine taking place there. Situation seems to be stabilizing in the Middle East. We had a number of actors coming in here, but there's still a number of minor tensions in different regions around the world. So there's a lot of volatility, there's a lot of uncertainty, and people are looking forward to see what kind of role the U.S. will play in the coming months.
And Jeremy, I wanted to ask you about the Bank of Japan. I mean, given your previous work in Japan's Ministry of Finance, BOJ just lifted interest rates to the highest in 17 years. Unlike many other economies, they're battling deflation. What was your overall reaction?
I mean, this was widely anticipated among the business sector. I've been looking forward to this. We have seen wage growth in Japan, inflation coming back, while a lot of the rest of the world is actually trying to reduce inflation. For Japan, this is actually a positive signal that we can actually start seeing realignment of production, changes in the job market. So overall, this positively received, and looking to see what will come next.
Well, thank you so much to Jeremy Jurgens, Managing Director at the World Economic Forum in Davos. And staying with Davos, where the UK Trade Secretary has left open the possibility of following EU rules for food and farm products in order to return to frictionless access to European markets. Jonathan Reynolds' comments come after EU Trade Chief Maros Sefcovic told the BBC on Thursday a new agreement, including so-called dynamic alignment on standards, is possible alongside other areas of pan-European cooperation.
Well, look, that was an incredibly positive and helpful contribution from Commissioner Sefcovic. I had a conversation with him today, a bilateral meeting in the jargon here, and I thanked him for that. Now, the individual components of that, he went through the arguments about the rules of origin and which sectors of the UK would benefit from that and which wouldn't. Again, a careful analysis of what that means for us. But I think it proves that what we have always said, that we can improve the terms of trade with the EU in a way which doesn't revisit customs unions or single markets or the arguments of Brexit. And we can do that whilst pursuing closer trade links around the world. I call it the twin track strategy, the best of everything. Well, I think we've seen a very positive response here in Davos to that.
And the interest rates in Japan, the world's fourth largest economy, has been increased to 0.5%, the highest level since 2008. Japan has been an economic outlier for a generation now. Unlike other major economies, it's been battling deflation, and that's kept the cost of borrowing there extremely low. That situation turned around last year when the Bank of Japan raised its interest rates from 0 to 0.25%, prompting a market sell-off. Here's Marika Oi with more.
This chart shows the history of the cost of borrowing in Japan, and for the past 25 years, it's been pretty flat. It was in 1999 when the Bank of Japan became the first central bank in the world to cut interest rates to zero. It was a bold move at the time. The country was experiencing falling prices, also known as deflation, and lower rates were meant to encourage spending and investment, at least in theory. But consumers weren't buying it. That's because the value of their properties and other assets were falling, so people didn't feel confident to spend money, and it slowed an entire country's economic growth. Then, in 2016, the Bank of Japan went further, taking the extraordinary step of cutting rates to below zero. Negative interest rates meant that the BOJ was, in some ways, paying borrowers to, well, borrow money. And they stayed there for over 8 years, hoping that prices would start to rise. Inflation finally arrived several years ago, but it was mainly due to higher food and fuel prices caused by the war in Ukraine. In March last year, the central bank moved rates to a range of 0 to 0.1%, a tiny rise but seismic shift in policy. The BOJ finally exited its negative interest rate policy. A few months later, the Bank of Japan raised rates again, this time to around 0.25%, showing their confidence in the country's economic recovery and that inflation is finally back. But that triggered a market sell-off because investors worry that they may raise rates too fast, and also because of a complex impact on the value of the Japanese currency. Officials have been cautious ever since, but they've hiked rates to 0.5% today. That's the highest in 17 years, and economists think they may raise the cost of borrowing several more times this year.
The Scottish capital, Edinburgh, a long favourite for tourists, will decide today whether to impose a tourist tax. Councillors recently concluded that a 5% levy on tourist accommodation was appropriate, and they're voting right now on whether to proceed. The local authority hopes to raise around £50 million, or around $60 million, saying the move would go towards improving the city. But businesses are nervous. Leon Thompson is from UK Hospitality Scotland, which opposes the levy. He told Business Today why he was concerned about the revenue.
It's going to be imperative that the money that the council raises is invested back into the destination to keep the city of Edinburgh a leading visitor destination, keep attracting people from all over the world into the city, and use that levy money to actually increase the value of the visitor economy. That's going to be absolutely key here. I mean, one of our concerns is that money will simply leak out and be used for day-to-day activities, but really we need to ensure that at least the bulk of the money does find its way into destination enhancement and promotion.
Thanks for watching Business Today. Goodbye.